Good morning, everybody. Mike Vaki, Princetontrader.com, here for ntmarkets.com with your Tuesday morning pre-market webcast. Okay, S&P 500 E-mini futures daily chart, and what we saw a failure to touch the upper band on Friday. Definitely by less than a handle, but still. You saw new highs yesterday, and then you saw over the course of the day, you saw those highs be backed off of. I'm not committed yet to the daily chart is starting to roll over camp, although you're starting to see signs that maybe we get a little bit of a pullback. And when I say a little bit of a pullback, I'm talking 1990 best case, maybe a little deeper, but not much. As I said last week, I think the point of this pullback is going to be to find a floor for the next move up. That said, we're still baseline overbought for 2 days, which is, pretty much unprecedented versus the 45-day pivot that I use. And we have broken below yesterday's low already. We've done as low as 2005. Yesterday's low was 2007. So for my part, I was short 2009 heading into yesterday. I took that off. I think it was for a, it was for a 2-tick loss, and we traded it from the long side. We traded from the short side during the day yesterday, and I ended up getting back in, putting the same trade on at 2017. I've already taken a third of that trade off at 2007 for 10 handles, and I'm letting the rest just kind of work with a free ride stop. So I'm expecting a little more downside. I'm not expecting this to turn into, not expecting this V to turn into an A. And I think people that are expecting that are the ones that have been burned the hardest during this move, and they are putting unreasonable expectations on the market. And if their response to you is, well, it went up that fast, why can't it go down that fast? It can't go down that fast because the bears really aren't that good. And my evidence of the bears not being all that good is that the bears aren't all that good. They tend not to follow through on things. We broke below the 200. We also did that back here, and they screwed that up for 3 months. Went below it here. That ramped for 3 months. So don't think that just because we traded on a sustained basis below the 200-day exponential moving average that this move back up to new highs doesn't mean anything. It means a lot. I mean, the absolute ideal for this trade would be a move down to middle band to test that. I would fully expect it to hold if it were to do that. Middle band right now is about 1935, and as you can see from the chart, it's starting to turn up pretty sharply, as you would expect. It's going to shed these down move candles, and it will be fully involved with the V in about 4 days. So this slow slope upward will become, it'll start to look like the 9-day where it's just kind of ramping up. So a move to middle band isn't out of the question, but it is not going to be as deep a retrace as it may seem to be at first blush. So the bottom line is the bears have done pretty close to irreparable damage to the chart, absent a major news bomb. And if you're looking for a pullback here, and I'm already short, you need to have reasonable expectations for where that pullback is going to take you. And when that pullback plays out, you need to be ready to buy that dip. That's the key. You can't say to yourself, well, there has to be more here. No, there doesn't. You have to be ready to buy that dip. Okay, that's all I got. Everybody, follow us on Twitter at Princeton Trader. Check out the website, Princetontrader.com. Check out the chat room. We've got people coming in, starting every day. Those people are coming. They're liking what they see. They're staying. We're breaking attendance records for us every day, and it's really exciting to see what's happening in there. So come join us. Come check it out. I will be back tomorrow morning with another website. Trade them well.